Now talk about the key features of corporations, which we will now refer to as corporate issuers, and why we are talking about them in terms of corporate issuers, because this company, which is your corporation, now can issue shares, right, which the owners can buy. They can buy these shares and become an owner in the company, and they are issued by this corporation. Hence, they are called corporate issuers because it is a corporation which is issuing these shares. It can also issue bonds, right? And investors can buy those as well. Of course, you don't become the owner of a company when you invest in its bonds. You become a stakeholder, nevertheless, but not an owner. So, in terms of your legal relationship, what is the distinction here? Of course, the legal entity is now a separate, distinct entity from its owners. Corporations have the same rights and responsibilities as an individual, that is, it can enter into contracts, hire employees, borrow, lend money, etc., pay taxes. So, it becomes a legal person. It's not a natural person, but nevertheless, it is a person, a legal person, so a separate person. And large corporations, of course, are very, very large. They are going to be spread across different countries and subject to different regulatory jurisdictions, even different than where the company is incorporated. So the company might be in the US, it might be doing business in Uganda, it might be listed in multiple places, right? And the most beautiful part is also the owner operation separation, that you can now bring in professional management, CEO, senior management, professionals coming in to manage the day to day operations, whereas the board of directors represent the shareholders who are the owners. So there is a separation between the ownership and the operation, and then, of course, you have unlimited expertise and capital that can be provided to the corporation, to the business. And why is that? Is obviously because there is a conflict between ownership and operation. And now that conflict is at least separated, that management is different, right? And ownership is different. But that conflict is not finished. It's just that two separate people are there now and they will have to deal with each other to kind of balance in that conflict. And that is where we'll talk about issues in corporate governance later on. That how can shareholders govern a corporation sitting on the board? So let's say this is your board of directors who represents the shareholders, and then this is your CEO and CFO and whatever rest of their team, right? Senior management, and then there's going to be a conflict among them. So how to manage that, how to align their interests, that is where corporate governance comes into play, and we'll be talking about that later in more detail. And if the board of directors is not able to properly govern the corporation, then naturally the shareholders have an ability to change them through their voting. And that is the key difference between a corporation and a legal partnership, that a legal partnership does not have the ability to change the board of directors or the general partner as such, whereas your corporation can change the board of directors and the CEO or the senior management as well. The shareholders can do that at their general annual meeting through their voting rights. Of course, the liability is now limited, hence the name limited liability company or limited company. So the word limited in the name of these companies is a fact that these companies now have a limited liability. The owners can only lose up to whatever they have invested in the business, not more than that. But nevertheless, so their loss, let's say you invest 100 million in a business, so that's what you can lose the most. So in terms of your profit and loss, let's say this is your profit and this is your loss. What is the maximum you can lose? 100 million, right? You cannot lose more than that because that is what you have invested. But then what can you gain? Unlimited. Because when you make a company, the company has certain assets, it has certain liabilities, and it has equity. You have put in the equity of 100 million. Let's say you took a loan from the bank of 100 million, and now you have assets worth 200 million. Now you do something fantastic with these assets. You invest in some medical research, and you come up with the cure for cancer, and your assets are now worth, let's say, 2000 million or 200,000 million or whatever, right? Huge growth. So your liability is not going to increase. You have to pay 100 million back to the bank, or maybe a little bit interest, so 105 million. But if this goes to 2000 million, right, that 2000 minus 100, which is 1900, is going to be your equity. And this is known as the residual claim. Residue as in what remains after paying. So if your assets become 2000 and your liability is 100, so what remains is 1900, and that is going to go to the equity. So the equity owners, or the capital owners, or the owners basically, right, are going to have the residual claim on the company's net assets. And that is, of course, once the liabilities have been paid. So they participate in the growth of the company. And because of this structure, it attracts a different breed of capital, right? It attracts a different breed of capital in your equity, because they know that now professional management is coming in, so unlimited expertise is available, and then unlimited capital follows. And even people who are not interested in buying equity because they don't want to take that possibility of a loss, right? So they will invest in relatively more secure investments such as bonds. So again, with the capital structure that we were looking at, you had put in 100 million here, and then somebody else is coming in and giving you another 100 million as debt. This could be through bonds, or this could be just bank borrowing. Either way, these people are interested only in earning interest and not becoming owners of the company. There are, of course, some special type of bonds that are convertible into equity, but we will be discussing them later. So in terms of access to financing, both of these, whether they are your common stockholders or shareholders, or your bond holders or debt security holders, they are both referred to as investors in the corporation securities. The security here will be bonds and here will be stocks, but nevertheless they are both securities and being bought by investors. The ones who are buying the stocks, they are equity shareholders, and they are getting a stake in the company, an ownership stake, right? The bondholders are also a stakeholder, but a different type of stakeholder. They don't get ownership entitlement, and they therefore don't get voting rights. Corporations are taxed twice. There is double taxation. So this is the price you have to pay for all the benefits you get for becoming a corporation. But is it worth it? Well, clearly yes, because the biggest companies in the world are structured as corporations. Now here is an example about double taxation. There is a French company previously known as Auchan Holding, now known as ELO, and it has an operating income of 838, and then it has to have paid corporate taxes of 264, right? And then the investors will pay tax again on the dividend received of 30%. So if we take both these taxes into account, what is the combined tax rate? And you can see that 838, then the corporate tax of 31.5% leaves 57.4. This is what is going to be distributed to your investors, and then the investors will pay another 30% on that. So the total tax paid is, number one, the corporate tax, and number two, the income tax by the owners. And if you divide that by the total profit, 52.1% is your effective tax rate for this corporation. So fairly simple calculation here. And here we have a very nice summary that shows us all the different points about sole proprietorship, general partnership, limited partnership, and corporation, and we have discussed all of these in detail. This is a nice summary to look at before going into the exam. However, what I would recommend is to more intuitively understand this, because you don't need to memorize all of this. This is very, very logical. Right. Now we'll talk a little bit about the difference between public and private owned corporations. Naturally, when we talk about public, we are saying that they are going to the stock exchange and listing their stocks or bonds over there, which means easily at any given point in time, you know what is the price of those stocks and bonds because they're trading publicly. Easy to buy and sell because, well, they are publicly listed, so you can easily liquidate your holdings if you're an existing investor and you want to exit, and somebody else can buy and enter, which is not the case with private. With private, you need to negotiate private deals, and it is more complicated to enter into an investment or exit an existing investment. How does a company issue shares? What is the process for that, and why would they not want to go public? So clearly going public is good because of your higher liquidity and higher price transparency. But the problem with going public, and I have been there, is the amount of disclosure requirements, because we have to then on a quarterly basis report to the stock exchange our intimate details of our business. Right. So public companies are usually listed on the stock exchange. This allows for easy transfer of ownership. Easily you can buy and sell shares, and existing investors that want to exit can liquidate their ownership by executing a sell order, and new guys can come in by buying shares in a matter of seconds. And the share price is continuously changing. You can see that over time. If there is positive news, it goes up, and vice versa. Now, private companies are obviously not listed, they are private, so we don't know what they're really worth because their stock price is not observable. And buying and selling is much more difficult because those deals have to be privately negotiated, which makes transferring ownership much more difficult. And that means your investment is locked up, right? If you're investing in a private company and you're unable to privately negotiate an exit, then you have to wait until it goes public. Now you might be thinking, who will want to invest in a private company? Well, a lot of people, because the returns are much larger than public. A lot of people actually want to get into investments in private companies much before they go public. They rather actually want to exit when they're going public, because when everybody else is buying, they want to sell and lock in their profits. So they want to join early in the company's life cycle, have greater control over the management, and have much larger returns than you would make in a public company. Now, public companies obviously raise a very large amount of capital compared to private. Private companies are slowly generating investment. So they take small amounts of investments in their early life. But then when that all comes together and the company grows and eventually goes public, so then naturally there's a large amount of investment that goes from the general public into the company and then trades in the secondary market. What that means is that when a company first comes for an IPO and gives its shares and takes the money, this is known as a primary market transaction. Later on, whoever are the people who bought those shares, right, when they buy and sell with other shareholders, this is known as a secondary market transaction. Private share issuance is obviously a much smaller amount compared to your public. And not everybody is encouraged or allowed even at times to invest in private companies because it's not for everybody, right? It's the lockup period is much more. You're not easily able to get out of it. So we don't want, if I speak from the perspective of the regulator, let's say the SEC. Of course, I am not a regulator, but I'm just trying to give you an example that what the SEC's perspective on this could be, that they want to protect the retail investor, they want to protect your average investor, and private investment is probably not for them because your investment gets locked up, you can't easily exit. Whereas in the case of a public, as we just discussed, is easy to buy and sell. So it's a limited space investing in private companies, and only accredited investors should be permitted and encouraged to invest here, who are sophisticated enough to take these greater risks. Because the regulation is reduced, there is lower amount of regulation in the private space. Public companies are forced to disclose their data, intimate details of their business every quarter, every 3 months. Private companies are not supposed to do that. They don't have to do that, which means there is reduced regulation, there is reduced monitoring, reduced oversight, and therefore reduced protection. And therefore, only sophisticated investors should be encouraged to participate in this space, who have a certain amount of professional expertise and knowledge. So, what are the cons or disadvantages of going public? And trust me, I have been there, it is a lot of work. The registration and disclosure requirements are a nightmare. You have to disclose your financial reports and other relevant material information every quarter. Any major changes in the shareholders, any transactions done by your officers, directors have to be reported, and they have to be made available not only to the company's investors but to the public at large. Why? Obviously, this makes it easy for investors, and current and future, right? So it's not just your existing investors but general public, because they could be future or prospective investors and analysts who study these companies. Private companies are not generally required to make these disclosures, and they are not subject to the same level of regulatory oversight. Now, how do you go from private to public? Of course, you can go for an IPO, which is the most common way of doing it. And here, new investment is going to be raised, right? Direct listing is just your existing owners exiting. It's like an IPO, and we're going to talk about these in separate slides as well, but let me just give you a high level understanding. Direct listing is like an IPO, but there is no new investment. It's just that existing owners are kind of exiting. Existing owners are probably partially exiting. So they want to sell some of their shares to the public. And direct listing is much easier to do. You don't have to hire an investment bank, and you don't have to, try and convince people for new investment. It's just your shares that you're selling. So it's much easier to do. Acquisition is where you get bought out by another company, and there is some more details in that area. So first, IPO. There is a complicated process for going for an IPO because you are going to take new investment from people. So the regulator is going to say, okay, please follow a structured methodology of doing that. So there are specific listing requirements. You have to come up with a prospectus, a financial model. You usually have to hire a consultant, and you could even hire an investment bank that underwrites this transaction, which means they guarantee it that if nobody else will buy those securities, the investment bank, which is underwriting this transaction, will buy those securities. Now, in terms of a direct listing, is much simpler compared to IPO. It is much faster, lower cost, because no need to get an underwriter and no new capital is being raised. It's just that the company is being listed and its existing shares are sold, or not all, some. So a partial exit by the existing shareholders. Now, in terms of an acquisition, it could be that it's just one large public company acquiring another private company, and therefore that private company becomes part of the public company, and therefore it goes from private to public. But there is a more complicated way of doing that, that the public company which is buying the private company has been made, that public company has been made only for the purpose of buying this private company. And this is called a SPAC, a special purpose acquisition company, which is a company formed for the special purpose of acquiring a private company. And at the time of making this company, the SPAC, we don't know which private company we're going to buy. It's going to be an unspecified private company. But there will be some guidance and direction that, let's say, we're looking for cancer research companies. So we will tell our investors when we're making this special purpose acquisition company that we are going to, and let's say within 18 months, we will specify a time as well, that whatever money you will give us, we will put it in a trust account. Whatever investment you are giving us through the IPO, we're going to put it in an investment account, in a trust account, and within 18 months, a finite time, we are going to buy one of the cancer research companies. Otherwise, we will give your money back to you. So this is how SPACs work. They are becoming very popular as well. All right, now there is some circumstances in which it's going in the reverse manner, that your public companies are actually going private. Now, why does that happen? And think of the Hilton deal, where Blackstone is a private equity house that bought Hilton, which was public, and then I believe they took it private, fixed it up, and then brought it back to the public again. Why they would want to do that is because we know private companies have less oversight, less monitoring, less regulation. So you can get your hands dirty a bit more easily when it's private. So a lot of companies do choose to go private. They delist, they remove their shares from the exchange. And sometimes when you want to buy a company and take it private, you have to pay a premium above the current share price. And I believe the Hilton Blackstone deal is a good example. So if I remember correctly, the Hilton shares were around 20, but Blackstone actually paid around 40. They paid double to buy Hilton from the public. But by the time they were done, the shares were worth 120, right? So go private transactions are initiated when investors believe that the market is undervaluing the shares and financing costs are sufficiently low to make these transactions attractive. And what that means is that Blackstone didn't use all of their own money to buy this company. I think they bought it for $26 billion, and of that 26, only $5 or $6 billion was or $5.5 billion was Blackstone's own money, and around $20 billion was debt that they had taken from the banks. So Blackstone took a loan to buy Hilton. 74% actually of that cost of buying Hilton came from a bank loan. And the bank was willing to do it because Hilton is a good company. I mean, it's a decent brand with a lot of assets. So Blackstone took this loan and bought this company for $40 a share, and then eventually within 5 years made it worth 120. And this is happening in developed countries, but if you talk about emerging economies, they've not reached that level of maturity in your private markets. So in emerging economies, it's still the normal flow where private are going to public, right? And therefore, the number of public companies is increasing in emerging economies. But in developed economies like the USA, it's going backwards. And the reason for that is in developed economies, the private capital space, which is your venture capital and private equity, and I gave you the example of Blackstone, but there are other very good examples such as Carlyle Group and various others that are very, very mature. So the private space is very mature in the developed economies, but in emerging economies it is still not the case, and they are still transitioning from closed to open market structures, and therefore they are still going in that normal situation of going from private to public. And their public companies are still increasing as their economies are growing. Now, obviously, in developed economies, it is reverse. It's trending downwards. Companies are going down. Number one, because public companies are merging. So, if two public companies merge, then only one remains. And of course, because of the thriving private capital space, which includes investing in smaller private companies, startups, which is venture capital, or larger private companies, which is private equity, such as the Hilton deal, and even giving loans to private companies. All of this is making it easy for private companies to access capital, so they don't really need to bother going public and have to deal with all that existing, the regulatory burden for listed companies. And there are obviously costs of compliance. So either private companies choose to remain private because it's just easier, and they are still able to access capital, so they don't need to go public, or you have that situation where you've got public companies going private, such as in the case of your Hilton deal, where they want to fix it up under lower level of monitoring and regulatory supervision. Okay, now in terms of the summary, here you have this chart which we have discussed in detail, all of these points. And then you've got your differences in all these points again from the perspective of your corporate issuers, separate legal entity, tax twice, and ownership and operation separation is there, access to capital is there, which is fantastic, and liability is limited. And then the differences between your public and private, that public easily you can transfer the ownership, private not so much, really difficult, you have to privately negotiate, but it's worth it because the returns are good. Public companies raise a much larger amount of investment compared to private, right? They are doing much smaller ones. And your public companies are subject to greater oversight. They have to disclose their financials, any material information. Major change has to be disclosed. Major changes have to be disclosed in terms of stock transactions of officers and directors. And private companies are not allowed to make these disclosures, and therefore they are not subject to the same amount of regulatory oversight.